Why who you marry matters more than your stock portfolio. Imagine you're the chief executive officer of a fast-growing tech startup. You've spent the last decade building this company from nothing. Late nights, missed weekends, sacrificed relationships. You've poured everything into creating something worth millions. Then one day, you decide to bring on a co-founder, someone you've known for maybe 2 years. And here's the contract you sign. This person gets immediate and unrestricted access to the company bank account. They receive 50% equity in everything you've built so far. But here's the kicker. They also get 50% equity in everything you will ever build in the future. Every innovation, every patent, every revenue stream for the next 30, 40, 50 years. It's all split 50-50. Oh, and you didn't run a background check. You didn't look at their credit history. You didn't verify their claims about previous business experience. You didn't even ask to see their financial statements. You just felt a connection with them. You loved their energy. So you signed. If you did this in business, you would be laughed out of every boardroom in America. Your investors would revolt. Your lawyers would have you committed. But millions of people do this exact same thing every single year. We just don't call it bringing on a co-founder. We call it getting married. My name is Charles, and today we need to talk about the most important financial decision you'll ever make. Because here's what they don't tell you at the wedding reception, when everyone's crying happy tears and talking about soulmates. Marriage isn't just a romantic partnership. It's a legally binding financial merger. And most people walk into this merger with less due diligence than they'd use buying a used car. When you get married, you're not just choosing someone to share Netflix passwords with. You're entering into a contract that gives another person legal claim to half of everything you earn, build, and accumulate for potentially the rest of your life. In most states, the moment you say, "I do," you trigger something called community property law. That means every dollar you make from that point forward is 50% theirs. Your bonus at work, half theirs. Your side business, half theirs. That inheritance from your grandparents, depending on how it's structured, potentially half theirs. And here's the part that should terrify you. In many jurisdictions, you're also now legally liable for their financial decisions. They rack up credit card debt, you're on the hook. They get sued, your assets are exposed. They have a gambling problem they've been hiding. Congratulations, you just became a co-signer on their addiction. Now, let's talk about the slow death scenario. The one that doesn't make headlines, but destroys wealth quietly over decades. Imagine you're a saver. You were raised by parents who taught you that every dollar matters. You max out your 401k, you invest in index funds, you drive a reliable used car instead of leasing something flashy. You pack lunch instead of spending $15 on takeout. Your natural impulse is to build wealth. Then you marry someone with the opposite wiring, a spender, someone who believes you only live once, someone who thinks having money in the bank means you're not enjoying life. They're not malicious. They're not trying to hurt you. They just have a fundamentally different relationship with money. So what happens? The financial death by 1,000 cuts begins. They insist on upgrading to a bigger apartment or house because we deserve it. That's an extra $2,000 a month. They need a new car every 4 years because the old one feels dated. They take expensive vacations because we work hard and should enjoy the fruits of our labor. They buy designer clothes, the latest tech, subscription services you didn't know existed. Meanwhile, you're trying to save. But every conversation about cutting back becomes a fight. Every suggestion to invest more gets met with, "You're being controlling," or "You're obsessed with money." The relationship becomes a war of attrition. You're trying to fill a bucket while they're drilling holes in the bottom. Let's run the actual numbers on this nightmare. Say you're the saver making $100,000 a year. If you were single and disciplined, you could save 30% of your income. That's $30,000 a year. Invested at an average 8% annual return over 30 years, that becomes nearly $3.6 million. But you're not single, you're married to a spender. Between their expensive tastes and the constant compromises, your household savings rate drops to 10%. Now you're only investing $10,000 a year. Over that same 30-year period, at the same 8% return, you end up with $1.2 million. $1.5 million? Gone. You didn't lose that money in a stock market crash. You didn't lose it in a divorce. You lost it because you were trying to build wealth while married to someone who was systematically preventing it. You spent 3 decades financially handcuffed to someone whose values were incompatible with yours. And the psychological toll? It's devastating. Every financial decision becomes a negotiation, every purchase a potential conflict. You can't build the future you want because you're constantly compromising with someone who doesn't want the same future. But Charles, you might be thinking, the slow death scenario is depressing, but at least we're still together. At least there's love and partnership. Here's the thing, the slow death is actually the better option, because we need to talk about the sudden death scenario. The statistics on this are brutal and nobody wants to hear them at wedding receptions, but we have to look at the data without flinching. Between 40 and 50% of marriages in the United States end in divorce. Think about that. If I told you there was an investment opportunity where you had a 50-50 chance of losing everything, would you take that bet? Would you invest your life savings in a coin flip? But that's exactly what marriage is from a purely statistical standpoint. It's a coin flip investment where the downside is total financial destruction. When a marriage ends in divorce, here's what happens to your wealth. First, you pay for lawyers. The average contested divorce costs between $15,000 and $30,000. But if there are significant assets involved or if your spouse wants to fight, that number can easily climb to $50,000, $100,000, or more. Then comes asset division. In community property states, everything acquired during the marriage gets split 50-50. The house, split it or sell it. Retirement accounts, your 401k that you funded entirely from your salary gets divided. That brokerage account you built, cut in half. Did you start a business during the marriage? Your spouse likely has claim to 50% of its value, even if they never contributed a single hour of work. But wait, there's more. In many states, if there's a significant income disparity, you'll pay alimony. This is where the legal system really shows its teeth. The court looks at something called the marital standard of living. Essentially, they calculate the lifestyle your spouse became accustomed to during the marriage, and they often require you to continue funding that lifestyle even after the relationship ends. So you could have a situation where you're the primary earner, making $200,000 a year, you get divorced, you split the assets, then the court orders you to pay your ex-spouse $70,000 a year in alimony for the next 10 years. That's $700,000 in post-tax income. And you're paying this while also trying to rebuild your own financial life, possibly while living in a studio apartment eating ramen because most of your income is going to someone you're no longer married to. Let's do the full calculation on a real scenario. Say you and your spouse built a net worth of $1 million over 10 years of marriage. You divorce. Here's the destruction timeline. $50,000 in legal fees right off the top. Now you're at $950,000. Split the remaining assets 50-50. You walk away with $475,000. But wait, you owe 3 years of alimony at $60,000 per year. That's $180,000. Now you're at $295,000. You started with $1 million in household net worth. You end up with less than $300,000. That divorce just destroyed 70% of your wealth. And this doesn't even account for the opportunity cost. You're back to square one financially, but now you're 10 years older with a decade of compounding returns permanently lost. Bobby, this sounds incredibly cynical. You might be thinking, what about love? What about partnership? What about building a life together? I'm not saying marriage can't be beautiful. I'm not saying love doesn't matter. I'm saying that love and romance don't change the legal and financial realities of what marriage is. And we do people a massive disservice by pretending these realities don't exist until they're sitting in a divorce lawyer's office wondering how they got here. And we haven't even touched on the hidden threat that most people don't discover until it's too late: financial infidelity. A study by the National Endowment for Financial Education found that 43% of Americans who combine their finances with a partner have committed some form of financial deception. 43%. That's nearly 1 in 2 people hiding spending, lying about debt, or keeping secret accounts. This is terrifying because of something called joint and several liability. If your spouse racks up debt, creditors can come after your assets, even if you had no idea the debt existed. You could wake up one day to a lawsuit because your partner took out loans you never knew about. You could find out your credit score has been destroyed because they opened cards in your name. You could discover that the down payment you thought you were saving for a house actually went to covering their gambling losses. The legal system says that even though you were deceived, even though you're a victim, you're still financially responsible because you're married. You're a financial unit. Their mistakes are your mistakes. So, how do we de-risk this massive decision? How do we protect ourselves without becoming cynical robots who think love is just a spreadsheet? The first step is financial vetting. Before you commit to spending your life with someone, you need to have the uncomfortable conversations. And I know this seems unromantic. I know it feels transactional. But you would never bring on a business partner without reviewing their financial history, and marriage is a bigger financial commitment than any business partnership you'll ever enter. You need to see their credit report. Not because you're judging them, but because credit history reveals patterns. Someone with 6 maxed out credit cards and multiple collections accounts isn't unlucky. They're financially irresponsible. That's not going to magically change because you love them. You need to know about their debt. Student loans, car payments, credit cards, anything they owe. Because once you're married, their debt becomes your problem. It affects your ability to buy a house, your combined debt to income ratio, your financial flexibility. You need to understand their relationship with money. Are they a saver or a spender? What are their financial goals? Do they even have financial goals? What does wealth mean to them? If your answer to what does wealth mean is financial independence and compound interest, and their answer is a Lamborghini and designer clothes, you have a fundamental incompatibility that no amount of couples counseling will fix. You need to see their actual spending patterns. Look at 3 months of bank statements. I know that sounds invasive, but here's the reality. People lie about their spending habits. Not maliciously necessarily, but they do. Someone will tell you they're pretty good with money while spending $4,000 a month on things they can't remember buying. The bank statement doesn't lie. Look for red flags in these conversations. If someone refuses to discuss finances, that's a red flag. If they get defensive or angry when you ask basic questions about debt, that's a red flag. If they have no emergency fund, no retirement savings, and no plan to build either, that's a red flag. If they make decent money but live paycheck to paycheck with no clear understanding of where it all goes, that's a structural defect in how they handle money. These aren't quirks. These aren't small differences you can overcome with love. These are fundamental incompatibilities that will create decades of financial stress. The second step, and this is where I lose half the audience, is getting a prenuptial agreement. There's this stigma that prenups are for rich people or people who don't trust each other. That's complete nonsense. A prenup is simply a contract that determines what happens to assets if the marriage ends. It's insurance. You don't get car insurance because you plan to crash. You get it because crashes happen and you want to be protected if they do. A good prenup protects both parties. It provides clarity. It forces you to have hard conversations about money, about assets, about expectations before you're in the middle of a divorce when emotions are nuclear and lawyers are running the meter. The prenup conversation is also a test. If you bring up a prenup and your partner immediately refuses, gets angry, or says, "If you loved me, you wouldn't ask for this," that tells you something important. It tells you they're either financially naive or they're viewing marriage as a financial opportunity. Neither is good. A partner who truly loves you and has their own financial house in order should have no problem with a prenup because they're not marrying you for your money. They're marrying you because they want to build a life with you. The prenup just makes sure that if things don't work out, you both leave with what you brought in, plus a fair division of what you built together. But let me flip the script for a second, because I don't want you to walk away from this thinking marriage is purely a financial liability that you should avoid at all costs. If you find the right person, if you marry someone who is financially aligned with you, marriage is the greatest wealth building hack that exists. Think about it. 2 incomes, 1 set of housing costs. That's immediate arbitrage. If you're both earning $70,000 a year, that's $140,000 in household income. But your rent or mortgage doesn't double. Your utilities don't double. Your Netflix subscription definitely doesn't double. You have massive economies of scale. If you marry another saver, someone who shares your values around building wealth, you can supercharge your financial trajectory. You can run a strategy I call dual income, no lifestyle inflation. You live on one income and invest the other. Or you live on 75% of your combined income and invest 25% from each of you. Over 20 or 30 years, this compounding effect is unstoppable. A financially aligned marriage is a fortress. You're making joint decisions about where to live based on maximizing income and minimizing cost of living. You're sharing a vehicle instead of each paying for insurance and maintenance on separate cars. You're buying in bulk at Costco because you actually have the volume to make it worthwhile. You're tag teaming childcare instead of paying for full-time daycare. You're building equity in a home together instead of both throwing money away on separate rent payments. The numbers on this are stunning. A dual income household where both people are disciplined savers can accumulate wealth at 2 to 3 times the rate of a single person, not just because there are 2 incomes, but because the expense efficiency creates additional savings that compound over time. And here's what people don't realize about the stay-at-home spouse dynamic. If one partner stays home with kids, that's not a financial drain if you run the math correctly. Quality childcare in a major city can easily cost $2,000 to $3,000 per month per child. That's $24,000 to $36,000 a year in post-tax income. If you have 2 kids, you're looking at $70,000 a year in childcare costs. If one spouse stays home, you're not losing their income. You're making a strategic decision to avoid that $70,000 expense while also getting higher quality childcare and more flexibility in your life. Plus, the stay-at-home spouse can often manage household tasks more efficiently, reducing costs on takeout, cleaners, convenience services. When you run the actual numbers, it's often economically neutral or even positive, but, and this is critical, this only works if you're aligned on the strategy. If the stay-at-home spouse decides to spend like they're still contributing an income, or if the working spouse resents supporting the household solo, the whole thing implodes. You need clarity on the division of labor, on spending limits, on what the long-term plan is. This brings me back to the core truth. Marriage can be incredible or it can be devastating, and the difference comes down to one thing: alignment. Financial alignment, values alignment, goals alignment. Here's the actionable play. If you're single, start thinking about money as a core compatibility factor, not a shallow one. Our culture tells us it's shallow to care about someone's income or their financial habits. That's garbage. Finances are the number one cause of divorce. Pretending money doesn't matter is how you end up in a decade-long nightmare. Date someone for their character, their values, their work ethic. But before you get serious, have the money conversation. Not how much do you make, although that matters too. The real question is, what's your relationship with money? Watch how they spend. Watch how they think about the future. Watch whether they're building something or just consuming. If you're currently dating someone, it's time for the financial disclosure conversation. Sit down and share everything. Credit scores, debts, savings, investment accounts, financial goals. If they refuse or get defensive, you just learned something critically important about your future. If you're engaged, get the prenup conversation started now. Find a lawyer who specializes in family law. Draft something fair that protects both of you. If your partner refuses, pump the brakes on the wedding until you figure out why. If you're already married and realize you have major financial misalignment, you need to intervene immediately. Set up separate accounts with a yours, mine, and ours system. Each person gets their own spending money that they can blow guilt-free, but the shared account funds the household and investments. You cannot just hope this gets better. Hope is not a strategy. Set up automated investing so saving isn't a monthly negotiation. Set clear budgets for discretionary spending. Get on the same page about big financial goals, even if you have to go to a financial therapist to mediate. And if you discover your spouse has been committing financial infidelity, hiding debt, destroying your credit, gambling away savings, that's not a small issue. That's a fundamental breach of trust that may require serious consequences, including separation if they won't address it. Marriage is a high-stakes game. The upside is infinite. A great marriage creates compounding returns financially, emotionally, and in terms of quality of life that you simply cannot achieve alone. But the downside is total ruin. A bad marriage can destroy decades of wealth building, derail your retirement, and leave you financially starting over when you're too old to recover. Treat marriage with the respect it deserves. Do the due diligence. Ask the hard questions. Read the contract, and choose your co-founder wisely. Because a broken heart heals, but a broken financial future lasts forever.